Hello, thank you so much for watching our presentation. We are the Norwegian School of Economics, and with me today I have Daniel from the US, I have Diego from Italy, and Norbul from Kazakhstan. My name is Håkon, I'm from Norway. And we are here to present you our analysis and investment recommendation for Tomra systems. All right, so we issue a hold recommendation with a target price of 114 Norwegian kroner, offering a downside of 15.3% to the closing price of 134.6. The reason lies on four main arguments. The first one being that Tomra is operating in an attractive segment with long-term fundamentals suggesting growth well into the distant future. Secondly, operationally and strategically, Tomra is well positioned to leverage himself both in new and existing markets. Our primary concern is a question of valuation because the current stock price relies on a best case scenario regarding market dynamics outside of Tomra's control and also assumes perfect execution into new markets. We also see uncertainty regarding the political factors and the exchange rate volatility as Tomra going forward. We have utilized three different valuation methods, the first one being the DCF, multiples, and Monte Carlo. Our target price is based on the DCF model because it relies on the fundamental values of the company. So we have rather utilized the two latter as a form of comparison. So Tomra is leading by the vision of leading the resource revolution. This is done by two main strong business areas, namely the collecting and sorting solution. In the collecting, they have the reverse vending and material recovery, which has been alongside Tomra since its genesis, and it has now several installments all around the world. In the sorting solution, they are trying to optimize their resource productivity through food, recycling, and mining, and now consists of approximately 50% of the global market share. Going forward, Tomra is also trying to position themselves towards the megatrends, such as emphasizing on circular cities and smart cities. Looking at Tomra at a glance, over the past 5 years, the share price of Tomra has increased by 179%, giving us an annual CAGR of 22%. This has resulted in a market capitalization of 20.6 billion Norwegian kroners, meaning now that Tomra is the 20th biggest city at the Oslo Stock Exchange. We also believe that Tomra is led by a strong and robust management with a diverse background and long experience. Furthermore, they are emphasizing on several corporate policies, such as the Norwegian Code of Conduct, ethical behavior, and also aligning their new CSR program with the UNESCO's sustainability program, which we believe will give credibility and stability for Tomra going forward. So, to my colleague, Diego.
Competitive positioning shows that Tomra stands among its peers for two simple reasons. Tomra reaches more market than its competitors and has a strong market share in each of them. Moreover, Tomra benefits from the substantial initial investment and technological knowledge required to enter the collection and the sorting market, making those two segments unattractive to newcomers. Tomra also shows better financial performance in terms of cash flow generation and leverage, a positive scenario that gives the company resources to grow through acquisition as they historically have. Many market factors can influence the demand for Tomra products. Legislative framework and government laws on recycling and waste management lead the growth of the reverse vending machines. Moreover, the urbanization may increase the utilizing rate of those machines, but high recycling rate among people who use separate collection can decrease the future need of the machines. For this reason, we believe that the main growth of this sector is the government laws, and without the new market openings, the only source of revenue are the replacement of old machines and the connected services. Food mining and recycling sorting can be done using automated machines or can rely on manual labor. Hence, market with cheap labor cost may be reluctant to choose automatic sorting solution. For these reasons, the sorting solutions the growth is driven by the technology development and labor cost. Moreover, new market segment can be found using new application or new technologies. Now, the word of Dan.
Great, thank you, Diego. So to take us through valuation and financial analysis, we're projecting a 3.2% revenue CAGR over the next 10 years. Also, we're projecting a continuation of current profit margin, so that translates also into a 3.1% net income CAGR over the same period. But our focus for Tomra, and really what we believe is important for the company, is revenue growth into the future. So we've made several assumptions regarding revenue growth. First, looking at sorting revenue, we're projecting a 2.5% revenue growth over our explicit forecast period. And this is slightly down from a 5% and 9% growth rate over the previous 2 years. But we've taken a conservative approach due to volatility in the business. And also as market share increases, we could expect growth rates to potentially come down from previous levels. Collection revenue, we forecasted the existing business at 2.5% growth, with additional growth being layered on top of that from expansion to new markets, namely 3 in Australia and 1 Scotland in the UK. So we believe our forecast is really a good case scenario for Tomra. We've made several assumptions surrounding this. So the first is that new markets that we expect to open will do so, and Tomra will be able to expand to those successfully. Continued growth in the existing business, and we've made no assumptions surrounding fluctuations in foreign exchange, which could affect the business going forward. And also, finally, we've projected stable expense ratios within the business in our model. So this is a look at our discounted cash flow model. So you can see we've forecasted free cash flow on an explicit basis over the next 10 years, with terminal value in year 10 representing 61% of the total enterprise value of Tomra. These have been discounted at a rate of 7.4%, and we've made an adjustment for net debt to arrive at a market value of 16.9 billion, which translates into our target stock price of 114 kroner. Next, Nurbal will take us through the rest of the presentation.
Well, in the Monte Carlo simulations, we simulated the stock price by altering the values for WACC, perpetuity growth, and the fluctuation in exchange rate. The mean value for 10,000 iterations was 116 kroners, and the first and third quantile values were within 10% margin from that value. It's worth mentioning that 70% of the simulations landed within the price range for hold recommendation, while only 2% of the iterations landed above the buy threshold. Now, to conclude the valuation section, here you see the range of prices for different approaches we used. The DCF range of prices was obtained through changing the perpetuity growth by 1%. Monte Carlo is first and third quantiles, while the comparable analysis is mean and max multiples. Comparable analysis has a wider range because of the Tomra's market multiples are way higher than the peer group. Overall, these methods support our initial valuation made by DCF. Now moving towards the risks, we identified 4 main pressing issues for Tomra going ahead, most important of them being political risk and currency fluctuations, because they have highest likelihood of occurrence and the highest severity in case of occurrence. Let me now elaborate more on the political risk. Highlighted regions here are the markets that are exploring the opportunities of depository system laws in the near future. While we have observed some legislative risks in the existing collection markets, as Iowa has introduced a repeal to the Senate regarding the bottle bill in the state, while Delaware has abolished its bottle bill in 2014. Overall, this means there's a limited number of new potential markets for Tomra's collection segment, while the existing markets are vulnerable to risks, and there's a high uncertainty if any of them will follow the Delaware example as in 2014. Okay, overall, based on our analysis, we issue a hold recommendation at the target price of 114 kroners. We base this on the fact that although Tomra operates on a very attractive market and with a high growth opportunities in the long run, we believe that market dynamics outside of Tomra's control and issues like political uncertainty around those new markets will affect the future earnings of Tomra. Therefore, we issue a hold recommendation with a target price of 114 kroners. Thank you for your attention. Now we open the floor for Q&A. Thank you.
All right. Well, thank you very much for a very good presentation. Let me kick off with a question. You mentioned that Tomra is growing on back of some of these structural green changes, the whole recycling trend. Then you forecast 2.5% growth and say that that's actually a good case. Obviously, it's your base case. The historic growth has been much higher. You also say the green growth agenda is there. So why do you say that 2.5% growth, or lower than historic, is actually a good scenario? Could you elaborate on that?
Yeah, thank you for your question. So we've forecasted revenue for both sides of the business, so for collection and sorting. With sorting, which relates to your question, we've gone with 2.5% growth, mainly as a sort of like taking it down, as you said, like a more conservative approach to the past. Part of this is the fact that we've seen so much volatility in this segment, so you can see these percentages have fluctuated quite a bit. And so we realized that issues like foreign exchange volatility could, in the past it has helped the business, but we could potentially have a negative impact from foreign exchange. And so it's really that risk and that unknown is why we took a more conservative approach to this business segment.
On collection, the 2.5% in collection?
Oh, yeah, so with collection, so we are actually forecasting 6% in the next year, and then 9% in the 2 following years, and then having that drop down to then 2.5% going forward. This is mainly due to the business relying on replacements and service revenue of the existing installations, with all new revenue growth opportunities, we believe, coming from new markets. And so those we've identified as the most likely right here in Australia and Scotland. And so really the impact of those is what's driving our valuation.
Just one follow-up on that. The 2.5% growth after the sort of the initial phase is arguably lower than even nominal GDP growth, although there should be some sort of green agenda. Is there any particular reason why you've gone sort of as low as 2.5?
So the reason we went with 2.5 is because like most countries have indicated like a 2% inflation target. So we believe we were slightly above that. And so, yeah, that's why we went with 2.5.
Okay, thank you.
Yeah, in the start of your presentation, you mentioned the strong strategic position of Tomra. You also mentioned that you see exciting opportunities for both main business lines. You also mentioned a strong management team sitting at the top of the company. We also have, on the back of our minds, as mentioned by my colleague here, the green wave that's coming over the consumer and over the different politicians. So I guess I want to, as my colleague here, point a little bit more to growth forecasts. Like having all this in the back of your mind, why do you land at the sorting revenue growth of 2.5%? And yeah, also the collection revenue. I'm quite interested to pick a little bit more on the drop off here from 9% back to 2.5%. Because in the back of my mind, I would say that you're basically then saying that after you've had those new countries open up, there's basically nothing that's going to happen for Tomra going after that. And how likely do you think that scenario is?
Thank you for your question. As we mentioned, we did see great growth opportunities for Tomra going forward, both strategically and operationally. The main concern is the political factors. As we've seen last year, for instance, China abandoned waste import, which affected the US hugely. And also the legislative framework going into the different countries. We cannot, it's so much uncertainty, so we didn't want to forecast a good scenario. We wanted to be a bit conservative, so we have that on record, yeah.
Great, and over to your valuation. I think you say that you forecast a free cash flow growth, so 7.4%, with a revenue growth of like 3.2% on average, with flat margins. Can you explain us how you get to that?
Yeah. So, yeah. So that increase in or the free cash flow is driven as we go from net or EBIT over like calculating free cash flow. Some of that is coming from the taking out depreciation and also the effect of working capital on the business. So there are some ratios that we've adjusted there, kind of taking forward current ratios. So some of that increase is coming from those calculations.
Yeah, and with all that new cash flow, have you made any assumptions about how they will deploy that cash flow that they generate?
We assume that the cash flows the expenditures of the free cash flow will stay at the same level as it was before. So they will keep their historical levels of spending of that cash flow. So the dividend policy will stay the same. Everything else is at the same ratios by our assumption. And as you can see here, you mentioned this graph. So it might seem that the net income line is going straight and it's hard to follow. But in fact, it's a scaling issue, and net income is actually following the same slope as the revenues. So if there was unclarity here, so that's it.
Where do you think you could be wrong? What is the market seeing that you aren't? And opposite, what is that you see that the market isn't seeing?
Well,
given that the share is trading far above your target price.
Yeah, currently, but we believe that market might suggest that the new markets will keep opening up for Tomra further than we predicted. So currently we know that the Scotland and Australian states are opening up for the deposit loss systems, and Tomra will be executing their operations there. But our assumption would be that the markets expect this new potential collection markets will open up constantly from year to year, and that's the difference from our approach. We believe that there's no certainty in that, so the political risks are too high to assume that the new markets will keep opening up from year to year.
That's good, and that's fair to implement a 2.5% revenue growth for the collection side, but 50% of the business comes from sorting solution, which isn't politically dependent, at least not as much. Have you broken down the markets there? Are there any regions that are more mature than others, or where do you eventually see the growth in sorting solutions? Then why is that only going to be 2.5% if there's not the same political limits or barriers that you have in collection?
So one of the main risks we see in the sorting segment is the impact of fluctuating commodity prices on Tomra's customer. So as they make these large purchases of sorting equipment, low commodity prices, which we're currently experiencing and could be coming out of, but the future is unknown, that could be like a headwind for Tomra's business. So it's things such as that although there is a market for it, it could be, we see headwinds coming from that direction in the future, and which we might disagree with the market on that point specifically.
Have you made any assessment regarding the length of the product cycle for sorting solutions?
We tried, but actually the renewal rate is not like a total driven in the sorting. It's not a total driver in the sorting solution, so we haven't accounted for that fact.
In the past, Tomra has made quite a lot of acquisitions, and it doesn't look like that you've added acquisitions into your forecast. So just very plainly, perhaps, do you think it's good that Tomra makes acquisitions? Should they do more or should they do less? Have you looked into that?
We have looked into that more as a management concern, because we see that the management is strong because they do a lot of acquisition and they actually increase the dividends. So we have looked at the acquisition as a factor for strong management, but we haven't accounted for this fact in the evaluation.
All right, so this is basically, it seems to me that I was going to run out of time, but your conclusion is that it's a quality company, but the market is overvaluing the company. So this is basically a valuation call. Should we short the stock? It's more, you have a hold recommendation with a 15% downside. Technically, that would be a sell recommendation. We operate with 10% as a sell. But still, and you can answer yes or no to this. Would you short the stock based on your conclusion, or would you just hold it? It stays for itself. I'm sorry, but
I will take it. If you. We're not supposed to answer. Okay.
it was my fault.
We can discuss it later.